Hello guys, and welcome back to my YouTube channel. So we are continuing with this chapter, money and banking, and that's an important chapter of class 12. So we have already completed the parts of money and a few portion of banking as well. And if you haven't watched that video yet, please do check the video. The links are provided there in the description box. Today we're going to learn about banking in detail. So please do check the last videos so that it becomes easier for you to understand this one. So let's start today's video. So we read that bank is an institution that is actually made for earning profits, right? Commercial banks, they earn profits, and the central bank works for the welfare of the people of the country. So now how do the banks actually they earn profits? And that main thing of earning profits is actually done by credit creation, or you can also call it money creation, that is done by the commercial banks. Now what is credit? The deposits, the money that we deposit into the bank. With the help of that, what do? They give it to the other people who are in need of money. It can be an individual, a corporate, a business house, it can be anyone. So they lend that money as a loan for which they charge a certain rate, and that rate is called the interest on that loan amount. So this is how they earn when there is a difference between the interest they pay and the interest that they charge. But how do they get so large amount for giving out as loans? So with the help of credit creation, they are able to give huge amounts of loan. Through this process, the banks are able to create credit, which is in far excess of the primary deposits that you and me go and deposit in the banks. And the credit that they create is way huge, way far than that. Let's check that with the help of an example. So here it is. So here you can see we have the primary deposit, like person A goes and deposits into the bank 1,000 rupees. That's the primary deposit. Now the third column that you see, cash reserves. So bank need to keep some amount of it, whatever the deposit they get, as a cash reserve, because there are chances that the people might come back to the bank and they want their cash back. So the bank keeps a cash reserve. But here an assumption is that not all the people are going to come to the bank at the same point of time to ask for their cash. So the cash reserve is very less in amount. So here you can see it is assumed to be 20%. So out of 1,000, that 20% amount is kept with bank as cash reserve. That makes it 200. Now out of the remaining 800, what do? They create credit out of it. So this 800 amount is given to person B as a loan, which is again assumed here that he is going to deposit in the bank. They are not giving him out as cash. So that 800 is again deposited in the account of person B. And out of that 800, again 20% is kept as a cash reserve and 160 is kept there. Now remaining 640 rupees, they again lend it to person C. So this is how the chain goes on and on. First, person A deposited the amount, then they kept a certain amount as cash reserve, because the banks think that the person might be there, he is back at bank and he wants his cash. So they keep a certain amount as cash reserve, and the remaining amount they give it to some other person in the form of credit. And this cycle goes on and on and on. And here in the total column you can see the primary deposit, they reached up to 5,000, whereas the person A, he just deposited the sum of 1,000. And the cash reserves, they have reached to the amount of primary deposits, and the total credit creation is to the amount of 4,000. So with just 1,000 being deposited into bank, the bank was able to create a credit of 4,000 rupees. So from this table we can understand the following three things. First thing, that there is 5 times the value of initial deposit that we have, that is the primary deposit. The initial one was just 1000 rupees, but the total one is 5000 rupees. Then the second point that we get to know from this is that the deposit creation, the primary deposit creation, it comes to an end as and when the cash reserves, they reach to the amount of initial primary deposit. Here you can see as soon as the cash reserves, they reached to 1000, that is what our primary deposit was. So now further primary deposits would not generate. So that's the second point that we can comprehend from this table. And the third and an important point is here when we talk about a new term, and the new term is money multiplier. So let us understand about money multiplier. So money multiplier actually refers to how an initial deposit, we saw that the initial deposit was just of 1000 rupees, can lead to a bigger final increase in the total money supply, and the total primary deposit reached to the value of 5000, right? So that is what money multiplier tells us. And the formula of money multiplier is money multiplier equals to 1 upon LRR. The full form of LRR is the legal reserve ratio, or you can also call it the cash reserve ratio that we had. So money multiplier refers to the amount that banks are able to create in the form of deposits. You can also say it like this way. Now here in our case, let's check what we get as a money multiplier. So 1 upon 0.20. Now how did we get this rate? We saw that our cash reserve ratio was 20%. So we converted that into points, into decimals. So that comes out to be here 0.20, and you divide that. So here you get your answer. Money multiplier is equals to 5 times. So you can actually see that deposit was 1000 and the primary deposit total was 5000. So that is exactly 5 times. So that is how we can say the bank was able to create 5 times the actual from the actual initial deposit that they had. So that's it guys for this video. Please do like and share my video and subscribe to my YouTube channel. Thanks for watching.